So good morning, everybody. Let's make a start. Thank you for joining today's session. I'm Sean Gibb. I'm the Events and Marketing Manager at Pro Manchester, and I'm delighted to welcome you to Deloitte's annual review of football finance. Following today's session, I'll send out a post-event email, which will contain any post-event collateral, links to where you can find out about other Pro Manchester events, and details around our Pro Manchester YouTube channel, where you can watch some of our sessions back. Just a couple of points of housekeeping. Please be aware that this session is being recorded. Feel free to use the chat function to ask any questions or just make any comments and observations. And we'll also open up to ask questions at the end as well, so you can come off mute and you can ask your questions directly to Zal and Samit if you want, so whichever your preference. Please just keep your microphones on mute for the time being. So without further ado, I will hand you over to Zal Udwadia, Manager, Sports Business Group, Deloitte.
Sean, morning everyone. Sumit, are you good to get the slides up, please? So just as Sumit's getting the slides up, my name's Zal, I'm a manager in Deloitte's Sports Business Practice, and Sumit's a part of our team as well. And we've both sort of been heavily involved in the production of this year's annual review of football finance. So I guess the purpose of today's call is to take you through the key findings of the report and hopefully give you a bit of a feel of the European football landscape and the main financial and non-financial trends impacting the industry. Just a bit of background on the Sports Business Group, where we're a team of about 20 specialists, all based out of Manchester, all working full-time in sport. We work exclusively on sports engagements, and the type of work we do is extremely varied, and our clients range from sports clubs to governing bodies to international federations to rights holders to investors. We work across the world, but I'd say about 60% of the work we do is in football. Next slide for me. Now, our annual review of football finance is one of our main publications that we do every year. This year, we recently released the 30th edition of the report. And a point to note is the numbers we're going to talk you through relate to the 2019-20 season, which, if you think about it, only has 1 quarter's worth of COVID-19 impact. That's from March 2020 onwards, when COVID spread across the world. So, next slide. Now, the European football market as a whole, I think it's fair to say, is going through probably its most challenging time in recent history. On the screen, you can see revenues for each of the top tier European leagues for the 2019-20 season. And when the pandemic spread across the world in March 2020, each of these leagues sort of took differing responses to the pandemic when it came to when play was paused, when play resumed, whether matches were played behind closed doors. Some leagues cancelled their seasons altogether, which really made the analysis this year even more challenging than it typically is. And the focus for today is on the 5 biggest bubbles you see on screen. So the big 5 European leagues. So English League, La Liga in Spain, Serie A in Italy, the Bundesliga in Germany, and Liga in France. And I'll take you through each of the big 5 leagues before Sumit deep dives into the Premier League in a bit more detail. We'll leave some time for questions at the end, but if you've got any comments, as Sean mentioned, just send them over in the chat function and we can take them at the end or as we go through. Sumit. Now, European football revenue in 2019-20 declined by 3.7 billion to 25.2 billion. And that's a 13% decline. And that's the first decline in European football revenue we've seen since the 2008-2009 financial crisis. Now, sports and elite football in particular is largely seen as a really recession-proof and a resilient industry. And even if you think back to the sort of 2008-2009 financial crisis, the decline in revenue that we saw then was really marginal, and it wasn't in any of the big 5 leagues. And even back then, you still had football clubs being sold for record valuations. But COVID-19, of course, was completely different, because for the first time, probably since the World Wars, actually, you had football paused for a prolonged period of time. And when football did resume, it was played behind closed doors. So each of the leagues across Europe was severely impacted financially. And it's probably the big five leagues that bore the biggest brunt in terms of absolute declines, with the big five leagues' revenues declining by close to 2 billion in 2019-20. Smith. Now, just going through at a high level what's happening at each of the big five European leagues in a bit more detail, and just to give you a bit of a flavor. But I guess to begin with, the business model of football clubs, if you think of it, it's actually quite simple. You know, the three main revenue streams. You've got matchday revenue, which is revenue from ticketing and hospitality. You've got broadcast revenue, which is revenues clubs earn from the sale of media rights for the league. And you've got commercial revenue, which is revenue from your sponsors and commercial partners. And each of these three revenue streams were in a way impacted by COVID-19. So in terms of matchday revenue, of course, you had matches played behind closed doors. So clubs almost lost a quarter of their matchday revenue with matches played behind closed doors. Broadcast revenue was impacted because across four of the big five leagues, you actually had clubs that had to pay rebates to broadcasters. And that's because essentially the product the broadcasters signed up for was different to what was produced, where you had matches behind closed doors and you had a complete change in schedule. So there were rebates to broadcasters across four of the leagues. And of course, the other complication was you actually had, because the season was paused in March, you actually had a proportion of the season that was played in clubs next financial year because play restarted in the summer. And typically football seasons and financial years neatly overlap. But because of the pause, like I said, you had a full portion of deferred revenue into the next financial year. So these were the three big revenue impacts across the European leagues. Now just going into each of the leagues in a bit more detail. So the Premier League, Sumit will cover, but Premier League revenues declined by 13% in 2019-20. And that's the first decline in revenue there has been in Premier League history. And both matchday and broadcast revenue were severely impacted. The Bundesliga in Germany was actually the first league to resume after the pandemic. And in doing so, they were the only big five league that was actually able to complete its season within club's financial year, which meant Bundesliga revenues only declined 4%. And in process, the Bundesliga overtook La Liga to become Europe's second largest football league, saying that the gap to the Premier League is still 60%. And that just gives you a sort of feel of the size of the scale of the Premier League. La Liga in Spain, there's loads happening at the moment, as I'm sure you're all aware. So La Liga revenues declined 8%. And what's interesting is La Liga is the only big five league that's yet to go to market to sell its domestic rights for the next broadcast cycle. So broadcast revenue is typically the largest revenue stream across the big five leagues. And recent deals in Germany and Italy where domestic broadcast rights declined by 5%. There were big decreases in France, which I'll talk about in a second. And the Premier League was actually quite smart in the way it was able to roll over its existing contract with Sky, BT, and Amazon for the same value. So it'll be interesting to see what happens with La Liga when they go to market at the back end of this year. But of course, more recently in the news has been CVC's investment into La Liga. Now look, there's always been investment interest into football, both private interest and from institutional investors. And over the last 10 or 12 months, we've seen this huge increase in institutional investor interest at a league level. You know, typically the interest has been at a club level, but we're starting to see interest at a league level. And typically how these investments tend to work is these big private equity houses have recognized that because of COVID, clubs are in acute cash flow problems and need funding desperately. So they make an upfront investment, which can be used by clubs. And in return, the leagues create this new separate entity that hosts the broadcast and commercial rights for the league. And in return for the investment, these private equity houses would get a small share of the future broadcast and commercial rights of the league and own a minority share in such an entity. So there was private equity interest across the leagues, and in Serie A in Italy was the first league which we heard about with private equity interests, where you had CVC and Advent make a 1.7 billion offer to own a stake in Serie A. Although the league was quite keen to pass that through, the clubs have halted the process, and that deal is on pause. In Bundesliga, you had about 30 private equity groups that were all doing the analysis and looking at a stake in the Bundesliga, but that was unanimously rejected by clubs. But just last week, you had CVC's investment into La Liga go through. So they had a 2.1 billion euro offer accepted, and they're going to own a small stake, a minority stake in this entity that hosts the broadcast and commercial rights. And in return, for the next 50 years, they're going to get a small percentage, about 10 to 11% of the league's broadcast revenue and commercial revenue. Interestingly, the two biggest football clubs, Madrid and Barcelona, along with Bilbao and a second-tier club, have opted out of the offer or the agreement, which means they don't get any upfront payment and they don't lose future revenues. Now, the upfront payment that CVC makes can be used for things like transfer spend and squad wages, a small percentage, but most of that's meant for clubs to invest in infrastructure. So it'll be really interesting to see whether that trend continues across the other European leagues and whether Bundesliga and so Serie A are more tempted to accept these offers. And look, CVC is really, they're the most experienced when it comes to sports investment. They've held investments in Formula One, they've held investments in the Six Nations, in the Premiership Rugby and in Pro 14. So it'll be really interesting to see what happens there. Revenues in Serie A in Italy declined by about 18%, and that's the largest decline that we had for the big five leagues. And in France, I'd say French football is probably in a bit of a state of turmoil, to be completely honest. I think the Messi transfer has glossed over what's been happening. But French football revenues in 2019-20 declined by 16%. And at that time, clubs were relatively relaxed. Well, it was the only league for a start to cancel its season altogether from the big five leagues, and that had huge revenue repercussions. But clubs were relatively relaxed because they knew going into the new season that they had this big new broadcast agreement with Media Pro coming in. And all their planning was based on this agreement coming in. It was a 1 billion, it would take French football broadcast revenues to over 1 billion euros, which is really closer to some of the big five leagues. But what happened was come December 2020, Media Pro pulled out and they stopped making distributions to the league, which meant French football was scrambling to find a new broadcaster. You eventually had Canal Plus that took over Media Pro's rights for the rest of the season, and then Amazon has just picked up the rest of Media Pro's package for this season onwards at a significantly reduced fee, which is close to sort of 3 times less than what Media Pro originally had in place. So you can see this impact that's had on French football. Of course, Messi moving to France will, of course, increase eyeballs on French football. It will, of course, increase commercial revenues, certainly at PSG and potentially for the league overall. And it's a shame that the transfer didn't happen just a few weeks ago when French football was negotiating with the likes of Amazon, because I'm sure the offer would have been significantly higher. Moving on to wages now. And as I mentioned previously, that the business model of football clubs is quite simple. I'd say perhaps the biggest flaw in the business model of football clubs is that you have wage cost and staff cost that take up anything from between 60 to 80% of their revenue, which is a huge percentage. If you think about it for a second, say in England, in the Premier League, with a wage to revenue ratio you see of 73% in 2019-20. What that essentially means is that for every 100 euros a Premier League club generates, 73 euros goes on staff cost and wages. So wage cost is a huge burden on football clubs. And the problem is wage costs are relatively fixed in their nature because you have players on contracts from anything between 1 to 5 years. So any decrease in revenue means it's arithmetically inevitable that the wage to revenue ratio across clubs would increase significantly. So in the Premier League, wages increased by about 4% in 2019-20, and that wage to revenue ratio increased to 73%, and that's the largest ratio increase we've seen in Premier League history. In Bundesliga, the wage to revenue ratio is about 56%. And look, German football has always been relatively well run. You know, they're the only Big Five league with a wage to revenue ratio below 60%. And that's partly down to the ownership model in Germany, where you've got clubs run a lot more sustainably because clubs know they don't have big investors to help cover the losses like some of the other leagues. But that ratio in Germany is still the highest it's been in the last 20 years. Now in La Liga, they have really tight cost control mechanisms. Their cost control mechanisms have been a bit under the radar. They've been in place since around 2013, but of course they've been in the news recently with everything that's happened around Messi. And essentially how this works is clubs need to submit a whole host of financial information to La Liga, and La Liga then runs an algorithm and then dictates or gives each club a squad cost limit to an extent, which dictates how much each squad can spend on both wages and transfers. And it's really interesting because La Liga's cost control mechanism is probably one of the few that are done in advance of a season rather than retrospectively. So if you think of the Premier League's regulations or UEFA's financial fair play regulations, they're all done retrospectively. But La Liga's is done in advance of the season. And, you know, Laporta came out and almost blamed these regulations for the reason why, you know, Messi couldn't be offered a new contract because Barcelona wouldn't be able to meet these regulations. So their strict regulations have helped keep Spain's wage to revenue ratio below 70%. And 70% is generally considered to be sort of optimal, or the optimal maximum for club health. In Serie A in Italy, they were actually the only Big Five league that was able to reduce their wage spend. But the huge increase, the lost revenue meant wage to revenue ratio was 78%. And French football, as I mentioned, is huge revenue losses, and their wage to revenue ratio increased to 89%. And that's the second highest ratio we've ever seen in Big Five history. Moving on to profitability now. And as I mentioned, the way football clubs are set up mean any decline in revenue typically flows all the way down to profit because it's so hard to cut costs and cut wages. And you had declines in profitability across each of the Big Five leagues. So Premier League profits declined by 900 million euros. Germany and Spain were relatively the way German football is run, and the cost control measures in Spain helped reduce the declines in both those leagues. And the Bundesliga is actually one of the only leagues that have stayed profitable for the last 20 years. Serie A was severely impacted, and we understand the Italian Football Federation is looking at introducing some form of cost control measures to help Italian football recover. And in France, the 575 million loss you see there is the largest loss we've seen in Big Five history at an operating level. And look, I think for all the criticisms of UEFA financial fair play, I think it's safe to say that if UEFA FFP didn't exist, the results you'd see on the screen would be a lot worse. If you stretch this graph back about 10 years before FFP was introduced, the aggregate losses across European football were in their billions. Moving on, before I hand over to Sumit to take you through the Premier League, it's worth just touching upon some of Europe's other leagues. So the Russian league is the 6th largest league in Europe, but you've got to take that with a pinch of salt because their financial year runs to December, which means there's no COVID-19 impact in those numbers. Interestingly, if I stuck the English Championship on this graph, they'd probably be the 7th largest league in Europe, and that just shows the strength of the English second tier and the depth of English football. Portugal's another interesting one worth mentioning because they're actually the only league still, or one of the only few, that sell their broadcast rights individually. So each club individually sells their broadcast rights rather than collectively. And what that means is a club like Benfica generates close to 15 times more than the smallest Portuguese club in terms of broadcast rights. And I guess the other interesting development is what's happening with Belgium and Netherlands, with the league possibly exploring a joint Beneliga, which would merge the two divisions together. So there's some research studies going on there. So it'll be really interesting to see if that does go through. I'll hand over to Sumit now to take you through the Premier League.
Cheers, Zal. So in this section, I'll be covering the English leagues, which primarily covers the Premier League, but there'll also be focus on the Championship, League One and League Two. So first of all, we'll dive into the Premier League and the revenues. So on the whole, the club's total revenues decreased by well over £500 million, as the average revenue per Premier League club reduced by 33 million to 225. And as Zal mentioned earlier, this was the first drop in revenue in Premier League history, and the lowest revenue total since 2015-16. So showing that the financial impact of COVID has been felt by all clubs. And one important revenue stream, as mentioned earlier as well, was match day income. So obviously this had an impact in 2019-20 due to the number of games played behind closed doors. But as this impact was the latter quarter of the season, it's not as great as what we're going to see in 2021, with pretty much majority of the games have been played behind closed doors. So as you can see in the projection graph, that's going to be close to nil. So that's obviously going to have an impact on all the clubs going forward. Another impact to revenue was the reported rebates of 330 million. That was agreed between the Premier League and the broadcasters, alongside certain broadcast revenue from 2019-20 being recognised in 2020-21 financial statements. And as a result, this saw the broadcast revenue fall by 23% to 2.3 billion, which accounted for 52% of revenue, when it had previously been 59% of revenue in 2018-19. Worsened performance as well by the Premier League clubs in Europe across both UEFA competitions was also a factor in the broadcast revenue generating a lower amount. And this is because UEFA distributions to the Premier League clubs fell by 90 million euros, which was an 18% drop to 395 million. And this is despite there being an extra English team competing in the Europa League group stage, which was Wolves. And in addition to this as well, Liverpool and Chelsea both received additional revenues for competing in the UEFA Super Cup final. So it shows that the worsened performance by the English clubs as a whole had a detrimental impact on the amount of broadcast revenue that they were able to generate. And so despite this being the first ever fall in Premier League history for the clubs, all 20 clubs were still in the top 50 revenue generating clubs in the world. Of those clubs, Manchester United is still the highest revenue generating club of any English club, being fourth. And other clubs that make up the top 10 were Liverpool, Manchester City, Chelsea and Tottenham, in our Deloitte Football Money League that we released in January earlier on this year. Part of the reason why the Premier League clubs have done so well and still in the top 50 is due to the commercial revenue that they're able to generate. So the impact of COVID-19 wasn't fully felt on commercial revenue, as deals were already in place, and as such, the commercial revenue actually increased. So what's going to be really interesting though is going forward is whether the club's going to be able to sustain such commercial growth. So we've already seen, for example, Manchester United having renewed their front of shirt sponsorship deal with TeamViewer, having previously been Chevrolet, but this is reduced slightly. So it'll be really interesting to see going forward how clubs are able to adapt and generate new commercial deals with new partners. So as we mentioned with the Premier League obviously generating a high level of revenue, there's obviously a clear polarisation, as you can see in the graph, between the revenue generated by Premier League and the Championship. But what's also worth interesting and noting is that there's a polarisation of revenue generated between clubs within the Premiership and within the Championship. So for the Premiership, for example, those clubs who compete in the Champions League generate on average around 3 times more revenue than clubs that just compete in the Premier League and the consistent clubs. And again, as you can see with the Championship, clubs that are in receipt of parachute payments receive around 2.5 times as much revenue as clubs that don't. And so the parachute payments are there to aid the clubs that have been relegated from the Premier League, to aid in the lost revenue that they're no longer generating as they aren't competing in the league. Now, with these parachute payments, they're obviously there to soften the blow for the clubs, but as such, it also causes a disparity between the clubs within the Championship, as can be seen by the levels of revenue they're able to generate. I'll touch a bit more later on into the Championship, so I'll focus a bit more on the Premier League for now. So, in addition to the Big Six, there are also 11 other Premier League clubs that competed in the Premier League in 2018-19 and 2019-20. Compared to the Big Six, a greater proportion of the 11 other consistent Premier League clubs' revenue was generated via matchday and broadcast, and these were the revenue streams that were hardest hit by COVID-19. As you can see in the graph, finishing the top 4, qualifying for Europe, is the obvious route to close the revenue gap to the Big Six for the rest of the clubs. However, the commercial appeal of the Big Six is strong and deep-rooted, and it was shown by those Big Six clubs accounting for 78% of the Premier League clubs' aggregate commercial revenue. And a good example of this is the largest commercial revenue generator outside the Big Six was Everton, and the lowest of the Big Six was Arsenal, and their difference in the commercial revenue that they both generated was 66 million. And so what's really going to be interesting, as alluded to earlier, was as an impact of COVID, it'll be really interesting to see how commercial partners react to the changing market conditions, and whether they're going to naturally gravitate towards the Big Six, who have a natural stronger fan appeal and customer engagement. And this could therefore increase the polarization between the clubs in the Premier League, but also the Championship. I'll touch upon later how there's also a few exceptions, both in the Premier League or Championship, of how clubs can generate commercial revenue as well to a high level. So moving on to wages of the Premier League. So as was also mentioned earlier, the wages to revenue ratio increased from 61% to 73%, but this was the largest year-on-year increase in Premier League history. And this is driven by the fall in revenue of 648 million, and also the additional 126 million on wages compared to 2018-19. Of all the 17 consistent clubs, only 6 of them were able to report a reduction in wages, and these 6 clubs were Bournemouth, Arsenal, Chelsea, Manchester United, Southampton, and West Ham. As you would expect, the Big Six were the top 6 wage spenders and accounted for 51% of the Premier League wage spending in 2019-20, compared to 58% of the revenue generated. However, it's worth noting that the wage gap between the Big Six and the rest of the clubs is significantly smaller than the gap between the revenue gap. So, for example, the lowest wage bill of the Big Six was Tottenham, and the highest wage bill of the rest of the clubs was Everton. The wage gap in 2019-20 was 10 million, which is nearly half of what it was in 2018-19 between the two same clubs, which was 19 million. And this is due to the Big Six clubs this year having been on average been able to decrease their wages by 2%. In contrast, the remaining consistent Premier League clubs increased their wages by 7%, and the 3 promoted sides increased their wage costs by 45% to try and compete in the Premiership. And this is due to clubs obviously attempting to battle the Big Six for European qualification or to achieve survival when being promoted. And as such, they're spending more to try and achieve on-pitch advantage. So as we mentioned with the wage to revenue ratio, UEFA recommend a threshold of 70%. 14 Premier League clubs have a ratio that's higher than 70%, and that's significantly higher than 8 in the previous year. Also this year, we have Bournemouth and Leicester having a wage to revenue ratio of over 100%, which is the first time since QPR in 2012-13. And what's really interesting is when QPR exceeded the ratio of over 100%, they were relegated. So by them spending an increase in wages, it didn't really help the team. And likewise with Bournemouth, they finished 18th in 2019-20 and were relegated. But on the flip side of that is, whilst there's obviously a higher risk, especially if it doesn't pay off and you do drop down to the Championship, Leicester have proven that by spending more on wages, they were able to improve their squad and they finished in the Europa League stages. So they were able to break the Big Six. So now it's obviously a question of whether they can maintain that going forward and obviously try and increase revenues to bring the ratio back down. So moving on to the profitability. So the Premier League recorded the lowest combined operating profit since the start of the century. And this is due to the combination of the wage cost growth and significant revenue reductions, as previously mentioned. This follows their operating profitability in recent years, with a high of just over 1 billion in 2016-17, followed by a reduction in the following 2 seasons. And this indicates that there's been a gradual trend of declining profitability that was already underway prior to COVID, and so potentially signifying a need for a greater cost control as revenue growth has declined. This is especially pertinent with the largest source of Premier League clubs revenue, which are broadcast rights, remaining at current per annum value domestically for the next 3 years. So it's obviously going to be really important to have to control the costs, and this is also the result for pre-tax results as well. So the lack of profitability of Premier League clubs was already evident in 2018-19, with COVID-19 just exposing the inflexible fixed costs that are in place, which resulted in record pre-tax losses. As such, there were 12 Premier League teams with a pre-tax loss of more than 50 million, compared to there being only 2 in the prior year, and only 4 clubs reported pre-tax profits. Of those 4 clubs, Chelsea recorded the highest pre-tax profit of 43 million, and this was in large part due to the sale of Eden Hazard. Burnley were another club to record a pre-tax profit and were recently purchased by American investors, and it's likely that financial resistance of the club was a likely factor in them deciding to invest in the club. 2 of the other clubs with a pre-tax profit were Norwich and Sheffield United, who were both promoted from the Championship. What's really interesting though is that the other promoted club, Aston Villa, actually recorded the 3rd highest pre-tax loss in the Premier League of 99 million, which is also the highest pre-tax loss of any promoted side. So now I'll move on to the football leagues itself, so including the Championship, League 1 and League 2. So as you go down, lower down in the divisions, there's a great reliance on matchday income. So as such, any loss of matchday income is much more significant for clubs compared to those that compete in the top tier. As such, the impact of COVID has been felt across the football leagues as a whole, and that's resulted in the previous 6 seasons for the Championship had revenue growth, but the 2019-20 season saw a 14% fall in Championship clubs revenue to 679 million, with broadcast and matchday significantly impacted. However, it's worth noting that the EFL had a new broadcast contract which commenced in 2019-20, so this massively reduced the scale of the overall fall in revenue, as it was reported that there's a 35% increase on the prior deal, and it's locked in for 5 years. And when this was initially agreed, it was looked down upon as being too long of a deal, as it wouldn't provide the Championship the opportunity to grow after 2 or 3 years. But now in hindsight, it's probably a blessing in disguise, because if the Championship were to go to market for tender, it's quite likely that they'll probably see a drop in broadcast value, as we're seeing across the big 5 leagues. So it's obviously worked out in their favour and hopefully allows them to maintain strong levels going forward. Of the Championship clubs, Fulham reported the highest revenue of 58 million, and a significant portion of this was the parachute payments they received from the Premier League. Leeds United were the next highest revenue, reported the next highest revenue of 57 million. And what's really interesting is they had the highest matchday and commercial revenue in the Championship by a significant amount. Their commercial revenue was 72% higher than the next best club, and the matchday revenue of 15 million was 84% higher than the next best club. Additionally, the 33 million they generated was higher than 11 Premier League clubs' commercial revenue, and that's really indicative of a strong fan base and the commercial appeal. So, as alluded to earlier, in terms of clubs struggling to break the top 6, I guess Leeds do have an opportunity if they're able to maintain their position in the Premier League and eventually try and push on European places as Leicester have done. They could potentially be one of the clubs that are able to do so. And so then moving on to League 1 as well. So their revenue did fall 16% to 166 million following loss of matchday revenue. This reduction would be lower though if Bury was excluded from the 2018-19 results. It would be 13%. And the reason why we'd exclude Bury is because they were expelled from the Football League following the financial collapse. In contrast to League 1, Championship, and even the Premier League, and I guess across the whole big 5 leagues as well, League 2 revenues actually increased by 2% to 98 million, as the new EFL broadcast agreement with Sky Sports commenced in 2019-20, and it's thought to have softened the overall financial impact that was for all clubs. So moving on to wages for the football leagues. So for the first time since 2003-04 season, wage costs of Championship clubs fell compared to the prior year, so they fell 3% to 813 million. And this is primarily driven by the club mix, as the consistent Championship clubs actually increased their wages by 4%. So it's therefore driven by the clubs moving between the Championship and the Premier League of the 2019-20 season. Given the adverse impact of COVID-19 on revenue, the wages to revenue ratio has also increased from 107% to 120%. And it's worth noting that at the time, 107% was actually a record. So again, there's a new record for the Championship, but it's unfortunately an unwanted record. But this really indicates the inflexible and stretched cost base of these clubs, and how important, obviously, getting promoted to the Premier League is to get the higher revenue to reduce the ratio. Within the Championship, there are only 5 clubs to record a wage to revenue ratio less than 100%. So whereas in the Premiership, 2 were over, only 5 were under in the Championship. Cardiff, Huddersfield and Swansea, 3 of the clubs to do so, and this is because they were in receipt of parachute payments. So being in receipt of these parachute payments has obviously massively aided them in being able to, I guess, generate the high level of revenue. And for those who don't know, with parachute payments, they're obviously given to clubs who are relegated after Premiership, and they range from being paid between 1 and 3 years, depending on how well the club does. The other 2 clubs to report a wage to revenue ratio of less than 100% was Barnsley and Charleston Athletic. And both of these were actually involved in a relegation battle. So it's indicative that they obviously hadn't spent enough wages on improving their squad. So that's why they were in a relegation battle and didn't have the squad capable to succeed in the Championship. Barnsley actually won their last game of the season to finish 21st, which relegated Charlton. So yeah, it's quite an interesting one to point out. And in contrast to League 1 and League 2, they were both able to reduce their wages, so by 10% and 12% respectively, compared to the prior year. So they've broken the trend of wage growth over the recent years. And it's worth noting that this relatively good control on wage expenditure is likely a direct result of the salary cost management protocol, which governs both divisions. So it'd be interesting to note going forward whether this continues to decline, or whether this will now be a new sort of wage level that they're looking to maintain. So focusing on the Championship's club losses. So as alluded to, wage costs have obviously been slightly down, but revenue was impacted significantly. And as such, it's not unsurprising that the Championship's club's losses suffered record operating losses, unfortunately, which rose to 434 million, and pre-tax losses, which rose to 508 million. Of the clubs, it's worth noting that the 3 promoted clubs, Leeds, Fulham and West Brom, accounted for 26% of both the Championship clubs' operating losses and pre-tax losses. And this further highlights the willingness of owners to absorb significant losses in their push for promotion. There were only 3 clubs as well which reported a pre-tax profit, which was Hull City, Luton and Swansea. But all of this was driven by net profit on player trading, as all 3 of these clubs had reported operating losses. And out of all the Championship clubs, there's only 1 to report an operating profit, which is Huddersfield Town. And this is obviously in part due to receiving the parachute payments, but obviously there are other clubs that were able to do that as well. The difference with Huddersfield Town is, whilst being relegated and receiving the parachute payments, they were able to actually reduce their wage bill. And so therefore, as such, they were able to report an operating profit. So with the losses of the Championship as a whole and the associated cash challenges that came directly from COVID, they reportedly piqued the interest of TPG Capital, and so they were understood to be considering to provide a 300 million cash injection to the league, which would go to all of the clubs, but in return they'd want to share in the EFL's commercial rights going forward. Ultimately, this deal actually ended up falling through, but in March 2021, the EFL did announce that they had secured a 117.5 million funding package from MetLife Investment Management, and the purpose of this package is to support the Championship clubs to try and improve the losses going forward. So hopefully there won't be record operating losses for pre-tax or operating next year. So moving on from the football leagues, just going to discuss a little bit about player transfers, specifically for the Premier League, but I guess covering general trends that we've seen. So across all the big 5 leagues across Europe, there's not as much spending as there has been in previous years. And it's obviously due to COVID, they're all in a poor financial position. So there's not the same level of activity as previously done, a smaller volume of transfers. There's less big money transfers happening across Europe, again, as a result of COVID. And whilst the Premier League is still spending more than any other league, as we've seen with recent signings of Jack Grealish and Romelu Lukaku, they're still spending much less than they have done in previous years, just due to the money's just not being there. And so aside from just the monetary transfers, there's been an uptick in loan transfers this window and previous window, especially with these loan transfers with an option to buy. And the reason is that benefits both the buying and the selling club, because the buying club doesn't have to offload their funds whilst they're recovering from lost revenues, and also the selling club are able to remove a player off their wage bill whilst they're trying to save costs. And another trend that we're seeing is an increase in the number of free transfers. And the reason for this is clubs are prepared to let the players run down their contract, as a lot of the time they're unable to renew at the current wage level that the player is at. And we've all seen recently, as Zal mentioned earlier, Messi, but PSG have been huge benefactors of that this window with Ramos, Donnarumma, a few other free signings as well. So they've also been very productive in that, and that's a trend that we think potentially is going to carry on going forward in the next few years. Whilst cash is tight, people are trying to recover still, and key players are running down their contracts. These are the sort of similar trends we're expecting to see again going forward. And again, another one as well with selling clubs is that previously they probably would have wanted one-off payments earlier on, but now there's a necessity to get players off the wage bill and to get immediate funds in. They're accepting staggered payments over the lifetime of contracts or a set defined amount of time. So it's really interesting to see how the transfer market has changed over the last year or two compared to how it probably was previously, and how it's going to uptick again in previous years and how it will be impacted. So I guess now I'll move on as well to, I guess, more specific information on the Northwest in general, as we are obviously at a Pro Manchester event. So as you can see, there are 5 Premier League clubs that compete in the Northwest, and they're a big part of society in the region. And the 3, Manchester United, Liverpool and Manchester City, are all powerhouses of England. And they actually have an economical and societal impact on the region, but also UK. So at Deloitte, we actually did a study on Liverpool a few years back for the 2017-18 season, just to work out the gross value added to the economies by Liverpool. And the results that came out was there was 463 million to Liverpool City, 517 million to Liverpool City region, and 604 million to the UK. So as you can see, these clubs actually have a big impact on the economy of their local region, but also the UK. Talking about the Northwest in general, so including all 4 leagues, there's 19 Premier League and Football League clubs. And on the whole, they generated combined revenues of 1.9 billion in the 2019-20 year. This is around a third of the 5.4 billion generated by all clubs in the top 4 divisions. And the 5 Northwest clubs, as you can see on screen, they generated 1.8 billion of this 1.9. As mentioned with the 3 big clubs that are the powerhouses, so Manchester United, Liverpool and Man City, these are all the top 3 revenue generating clubs in England, with Everton being 7th and Burnley being 12th. Those 3 clubs again, Manchester United, Liverpool and Man City, were also in the top 4 of wage expenditure. So Manchester City were 1st, Liverpool 2nd and Manchester United were 4th. And additionally, just covering the whole of the Northwest, there are over 5 million attendees to the Premier League games and Football League games in 2019-20 season, which is significantly lower than the 2018-19 numbers of 8 million, which is due to the number of games that were unfortunately played behind closed doors or were not played at all. That's obviously had a detrimental impact. And finally, just to cover off the Northwest and the Premier League clubs, of the 5 that we saw on the screen before, 4 of them actually feature in the top 20 revenue charts. So both Liverpool and Everton actually improved their positions by 2 places. Manchester City did remain at 6th, and Manchester United did unfortunately drop down a place, but they're still the highest revenue generating English club. And so overall, it's actually a really positive performance for the Northwest in general, as 4 of their 5 Premier League clubs are in the top 20 still, with 2 of them improving, and the other Premier League club, Burnley, being recently taken over by their American investors. So the potential for them to continue improving as well. So that basically covers off the Northwest, and I'll now hand back over to Zal just to go over some key trends that we've seen in sport recently.
Thanks, Sumit. I'm conscious of time and I want to keep some time for questions at the end, so I'll just whiz through a few of these. So in terms of tightening governance and regulations, we're seeing Spain have really tight cost control mechanisms. UEFA, for example, are undertaking a complete revamp of their financial fair play regulations. So that's a trend we think will continue given the current sort of financial environment in football. Now, new technology and changing consumer habits with the rise of OTT, consumers wanting content on the go wanting short form content. You know, if you look at the 100, which is set up to target a particular demographic, and the increase in technology. So NFTs, if you haven't heard about, is worth reading up on. Fan tokens are becoming increasingly popular. So there's this huge increasing convergence between sports and technology. A couple of other ones worth touching on, I guess, are fan influence and control. So probably one of the only silver linings from the Super League fiasco we had a few months ago was just the collective response of fans and the collective response of football. And I think it was just special the way fans came together to, in a way, put a pause to the Super League. And as a knock-on impact, you're going to see fans demanding greater control and greater influence on the way clubs are run. And you know, a number of the Super League clubs have offered fans positions on the board, for example. And moving on to two probably real challenges football and society in general is facing, climate change and racism and discrimination. You know, sports and football, I think, have a really powerful place in society in terms of their influence and the sort of levels of awareness they are able to generate. So it's been really great to see football taking the lead in terms of raising awareness around tackling racism and discrimination with things like the social media boycott we had a few months ago, with the players taking a knee before every match. And it really requires a sort of collective response from all the football bodies. But I think the fact that we're here today and we're able to just talk about it is just steps in the right direction, and football's really playing a leading role in that. And I think finally, it's worth just touching on women's sport, because the way I think about it, at least, if you look at the levels of revenue women's sports generate compared to the interest levels, they don't quite stack up. There's huge interest in women's sport. You know, you had 1 billion people tune in to watch the last World Cup in France. You had pre-COVID, you had attendance records smashed across each of the big 5 women's leagues. In football, you had increasing sponsorship with Barclays, sort of 10 million agreement for the Women's Super League, and a new broadcast agreement between Sky and BBC and the WSL, again, a record level for women's football. And it's a bit of a virtuous cycle, right? Because the more investment into women's sport, the more commercial investment, the more money flows down to players and to governance and regulations. The more money there is in women's football, the more young people you have that can make a career in women's sport. The more people in the pipeline, the greater the quality, the greater the investment again. So it's that virtuous cycle that's kicked in. And I think you're going to see huge increases in women's sport as time goes on. And finally, it'll just be interesting to see the ongoing impact of COVID-19 and how clubs and football are able to navigate the challenges as the years go by. So that's all we had for today. We've got some time to take any questions or comments. Feel free to fire them if there are any.
Hi everyone, please do submit your questions. You can either come off mute and ask your questions directly, or if you'd rather write something in the chat, please do. I have a question to get things kicked off. So I saw in the news recently that that UEFA are set to overhaul the financial fair play rules. I guess that might have been sped up by the fact of the what happened with the Super League last season. Do you think it's time, and do you think it would work to implement a rugby-style salary cap?
That's a good question, Sean. So in terms of UEFA's financial fair play, I think just to start with, so we tend to see financial fair play mechanisms for 2 purposes, right? One is to achieve competitive balance. So that's what you have in America, for example, with the salary caps and things like that. And the other is to increase sort of sustainability. And UEFA's FFP rules, when they were introduced, were focused on making clubs more sustainable. And if you think back to pre-FFP, sort of the cumulative loss in European football was close to 1.7 billion cumulatively. And as FFP kicked in a few years after, about 5 or 6, 7 years after they were introduced, European football as a whole collectively made a 500 million profit. And that really just shows the impact FFP did have in terms of increasing sustainability. So it was designed for a very specific purpose, and I think it's achieved that to an extent. But as the football environment and the financial environment around sport and the world has changed, I think it's only right that FFP does evolve. And it'll really be interesting to see what shape the new regulations take. I feel like there has to be some form of wage control, perhaps transfer control, transfer spend control, that could be kicked in. So it'll be really interesting to see how that develops. And I think by the end of the year, we should have some initial indication around what direction that'll go in.
Great, thanks, Zal. Anybody else with a question? Don't make me pick on you. You pick a name at random. No, I'm not, I'm joking. We've got a question in. Will the likes of PSG and Manchester City be able to comply with the UEFA FFP given recent high-profile signings?
I guess the best way to answer that is it's difficult to say. Well, for a start, UEFA's FFP regulations have obviously been relaxed because of COVID-19. And they've historically looked at things on a 3-year cycle. But because of COVID-19, they're almost in a way ignoring the year impacted by COVID and taking an average of 2 years. And I think there are mechanisms where clubs can be exempted, where if it's proved that losses were due to COVID-19, they'd still be in compliance. But so it's difficult to say at this stage. There's still sort of a few weeks left in the transfer window, and there'll be business to be done, I'm sure, across both clubs. So it'll be interesting to see how they do and if they do meet these regulations. But of course, FFP's been relatively relaxed because of COVID-19, because every club would struggle to meet the current regulations because of what's happened.
And do you think that the general disruption in the last 18 months will increase the players' motivation to transfer?
I don't think so. I think, look, football's I think the last few months have really demonstrated the resilience of the football industry as a whole. There's this whole pent-up demand for fans to go back to watch matches in the stadium. There's this whole pent-up demand to watch football, and even through the pandemic, you had viewership numbers through the roof. And I don't think, from a player's perspective, anything would change in that sense.
Okay. If there aren't any more questions, we will leave it there. It just remains for me to say a huge thank you to Zal and to Samit and to Deloitte for hosting this session, and a huge thank you to all of you for attending. So thanks, everybody.
Thanks, everyone.
Yeah, cheers, everyone.